Welcome to another episode of the Capital Playbook. My name is Charles Williams. I am the owner and managing member of Pioneer Realty Capital. Today we're going to talk about financing multifamily properties. Now this is a subject that we've talked about before, but we're going to talk to a group that's kind of new in the game, maybe not new in the game, re-entering the market, a name that you haven't heard of before maybe, but we're going to talk to someone with Regions Bank. What's Regions Bank doing today, and what are they doing with regards to multifamily, and what are they doing with regards to CMBS lending? Today we have their subject matter expert with us. His name is Mr. Austin Barrett. Austin, thank you so much for joining us.
Happy to be here. I appreciate kind of jumping on with you guys and talking. I definitely am happy to be here to help sell Regions Bank, to help kind of explain what's been going on in the market, what's been going on with Regions. Regions has taken a huge step forward in the last 12 months, and it's through acquisitions, it's through growing, it's through, Regions is really here to step up in the market, to become a top player, to become, one of the best, if not the best, lender out there for multifamily, for CMBS, for all things financing throughout the market.
Wow, that is quite ambitious. So, tell us about you. How did you get started in the lending business? You went to school in Arizona, right?
Correct. So I went to school in Flagstaff, Arizona, Northern Arizona University, got my accounting degree there. I always loved numbers. I loved, seeing how things worked, what made money, what didn't. But really where I started was I worked at CBRE in their accounting for commercial real estate. So I had 7 properties across the U.S. that I was doing a car factory in New Jersey. I was doing a 7-story office building. So I really got to understanding of how these, properties ran, because, these weren't owner occupied. These were, GMC operating a factory in New Jersey that Sarah owned the property. Her family's owned it for 30 years. So it was interesting to me to see that side of commercial real estate, the accounting side. And as much as I loved it, I realized there's a whole different side of things that I wanted to explore. And so from there, I got a call from a good friend who was living out in Texas and said, hey, come on out, come join the company. I'm working at Hunt Real Estate Capital, who was then bought by Oryx and then is now Lumen. But so joined on with them, and I was on their small balance loan team, underwriting deals, inspecting deals. I was on the road probably 3 days a week, going out, meeting the property owners, seeing the tenants, seeing the units, and that's where I really kind of fell into the love of commercial real estate. And honestly, the small balance world, the $1 to $7.5 million loans, the Class C properties, the working class, it was a different grind. It wasn't what I would call, it's not the sexy asset. It's not they've got a sauna, they've got a golf simulator. It's, these are the people that are helping making our country, survive day in, day out. So it was nice to be able to go out there and see how things are going and see how, we can help on the financing side. Because sometimes, property owners would then go cash out their property to put in more improvements to, go and upgrade the units for the tenants. I mean, we've seen tenants, the longest tenant I think I've seen that's lived in a Class C was 42 years.
Wow. Yeah.
Moved in when they were in their 20s. Loved the owners, never left. Property is their home. Yeah. So this is a lot of people's homes, and that's how they view it, and that's how we want to view it too. So we go out there, we see, and we hold the owners accountable. We want to make sure that they're keeping their property up to the tip-top condition, because everyone should be. People are living there. You want it to be the best it can be. So I think at Hunt is where I really fell in love with it. I was out inspecting with Freddie Mac on, pretty much every single time. And that's where I, took the next part of my career, was going to work for the agencies. I saw how it worked on that side of things, and I really wanted to go across and really work with the agencies to see how, the cookie was made.
Right.
Wanted to see all the bits and pieces on the back end, the front end. With Freddie, they securitized the loan on the back end. I really want to understand where the agencies really came in, because, from what I knew was, oh, that's part of the government, and that's what most people really think is Freddie and Fannie are just, it's part of the government, and that's all they really know. And it's such a different beast. So I worked at the agencies for 5 years. underwriting. I was probably touching 150 loans a year. They had a 9-day turn, so I would get an SBL loan in underwriting. Day 1, day 9, we'd send the commitment out.
Wow.
So it was a full, the shop was always moving. There's always deals coming through. And, the last few years, I'm sure as you know, real estate, commercial real estate, really took off on an exponential level for the small balance stuff, the Class C. It became the new sexy asset that everyone wanted to buy. Everyone wanted to go in and flip and fix. So I joined, and we hit the ground running. There's no stopping. You take vacation, you've got deals still coming in, you've got deals. The market never slowed, which was great, which was fantastic. And I learned so much over those 4 years of the ins and outs, the gray area that you can play in. As much as the agencies love to say it's black and white, I think, the gray area is the best area because the agencies will listen to the story.
Yeah, that's interesting. Actually, we were talking with an attorney who represents the agencies as their attorneys in preparing the loan documents, and that's one of the things he mentions, that if there's a story, especially on the SBL side, that they will listen to the story. Now, you mentioned that with CBRE, you were doing the accounting. So were you basically an asset manager when you were working?
No, so we were running the financial reports. We were doing the full, CBRE had its own accounting, system. So it was part asset management, but where I really was I was the accountant for them. So I was like the personal accountant for these properties. I got the rent sent into, the program that we were using. I put it into the right bucket. They would send me, CapEx items that they were doing or utility bills, things like that. So I really became, the accountant for these properties.
Interesting. So that gave you a depth of experience from an accounting finance perspective, knowing what a good deal looks like, right?
Exactly. I think that's, the thing I tell everyone is everyone can see commercial real estate. Everyone can go look and, it's on LinkedIn. It's on every, Facebook ads now. It's all over the place, but it takes a whole nother level for a person to understand what a good deal actually looks like and where you can find success, where you, can value and appreciate the asset and know that it's going to succeed.
Yeah. So now you've taken all of this experience. You were at you ended up at the agency. But at some point, you decided you wanted to go back to the private side. How did that happen, and where did you end up?
Yeah, so that happened, I think, really what it was I love talking to people. I love hanging out. I love, just enjoying people's company and getting to learn them, getting to learn, what makes them go every day.
Right.
So whether that's in their personal life, whether that's in their, real estate side of things, and I was really missing that at the agencies because I was behind the screen working. The phone calls I was making was, hey, I'm getting your DCL out tomorrow, I promise. It's on its way, it's in for review. And it just wasn't really fulfilling what I really felt like I could exceed at and where I could grow and where I could help people. And so I had worked with, at the agencies, I worked with every lender. Every lender is great at what they do. They're great in their own ways. And I think where I found my niche was I wanted to work with somebody that I knew and I knew what they produced as well. I wanted to work with somebody that kind of stood up and was up to the level that I wanted to be at in my personal career. And so that's where I ended up. It was a tough decision because I loved the people at Freddie are family. The people, everyone is so close. Everyone, really works together to help each other out, but I still work with them daily. I still call them and say hello. I still call them and say, now I'm on the other side and I can call them and say, where's my DCL? Right. But I just chose to make the jump over to Sabal Capital about, I think it was almost a year ago to the day. Jumped over to Sabal Capital and loved every minute of it. But the interesting thing about Sabal Capital was when I jumped over, I was their first Regions Bank employee. So Regions.
You're going to tell us what's the connection between Sabal Capital and Regions Bank?
Yeah. So Sabal Capital couldn't hire anybody for about a month, and so I was sitting there kind of waiting. They're like, just hold on, we're trying to figure out what's going on. And so what ended up happening was Regions Bank acquired Sabal Capital, and so with acquisitions with the agencies, it takes a lot more time because Freddie has to approve it, Fannie Mae has to approve it, goes through the legal fun stuff that is way above my pay grade, but they finally, everyone kind of agreed to the same terms, everyone got on the same page. And so then when I joined Sabal, I was actually joining Regions. And so Regions Bank acquired us, I'd say about December of 2021. And so 2022, we were operating as Sabal Capital, or Regions Bank doing business as Sabal Capital. But as the time comes on, we're merging further and further together, and we're just awaiting for the final approvals of the agencies to switch from the Sabal Capital into the Regions Bank names for the agency SBL, because there's only a certain amount of lenders that have that license. Right. So we want to make sure everything's vetted, approved, and again, go through the legal process to make sure all that's squared away. And so when I joined, I was the first Regions employee that was hired. I was hired under Sabal, but was the first Regions employee that Sabal hired. Okay,
interesting. And of course, Sabal Capital has been one of the leaders in SBL lending for a number of years now. And it's interesting to see the level of expertise that you bring to that organization, because it's always good dealing with an inside man, right?
Exactly. And the insights of the relationship. Yeah. It's a relationship business. It's kind of, as we were saying earlier, it's about the story. And, the better relationship you have with Freddie Mac, with Fannie Mae, the easier the story becomes a conversation, and it's a discussion. It's, hey, I want to help this person get this deal done. I need your help to, get this exception approved. Here's the information we're presenting. Here's why it happened. Tell us your concerns. Let's work together on finding a good outcome that benefits everyone. Right. And so that's where the relationship that I had with Freddie and, had with Fannie Mae, due to, Freddie people jumping from Freddie to Fannie, there are still relationships all over the board that, we grinded together, and it's at the agencies, it's a family. I mean, once you're in there together, it's forever. Yeah. And so that's been the benefit of me joining Sabal, is I've had these relationships. I've, got the inside knowledge from underwriting the deals and seeing 150 loans a year. You see what's been put through, what hasn't been put through, where you can, play in the gray area and where you can't. And that's where I really enjoy leveraging, the relationships that I have, the knowledge I have, not only helping myself, but helping the entire Sabal Regions team go from, maybe a number 6 lender to number 2, number 3. I'm really hoping we get to number 1. It's a big step, but, we have one of the most capable teams. We service our own loans. We've got, it's a family there as well. And that's one thing that when I left, I wanted to join a family type environment. And since being acquired by Regions, it's, been the exact same thing. They brought us in, they've been nothing but helpful, and they want us to succeed as much as we wanted to succeed just being Sabal. And now we have so many other platforms and capabilities and resources across the country that we didn't have as Sabal.
Yeah. And what is the footprint for Regions Bank? They have a national footprint, or regional, or what?
Yeah, so they're mainly kind of a southeast, East Coast bank. Birmingham, Alabama is where they're based out of. Okay. They've got locations, I would say if you cut the country in half, pretty much the entire East Coast, they've got locations all throughout. Sabal was based out of California, based right around here. And so that's where it really was, they wanted to get a bigger presence across the country, and by going with the West Coast Sabal Capital, who we do deals everywhere. We'll go to Alaska, we'll go to Hawaii, we'll do California. It's a nationwide effort that, and the team that we have has, done deals in cities that I never knew existed, and done deals in, Dallas, Texas, New York, the bigger cities. We're all over, and Regions really liked that. Regions really liked the footprint that Sabal was also bringing to the table, that it wasn't just, the Regions footprint. It's now, the entire Regions Sabal, which covers everywhere. Yeah,
well, I can see that's a significant fee income. Now, you also mentioned to me that outside of doing multifamily agency lending, that Regions has also started taking a look at CMBS transactions, commercial mortgage-backed securities. Tell me a little bit about that business and how does it work with Regions?
Correct. So CMBS was actually also a part of Sabal. So Sabal had a CMBS program that, we again have great people that run that program. And so we do see some multifamily going CMBS. We prefer it to go agency, but the CMBS platform, we can do hotels, we can do industrial, retail. The platform encompasses everything, that's outside of multifamily. The office buildings, the Chick-fil-A's, any type of store, any type of commercial property that is not, even multifamily, like I said, but any other property is where CMBS really succeeds, and it's picking up. I mean, CMBS across, I think, the country in the last month has really started to, it was at a halt through COVID. I mean, COVID kind of hurt that market because of the office space, because nobody was going to stores, nobody could go to stores. So now that things are, I would say, stabilized again, we've got more stable income, we've got more stable tenants, that program's starting to pick back up, and, everyone's being aggressive on it. Everyone wants to help people that may have been struggling through COVID, and we want to get them back to normal, get them back to, succeeding at what they do so that they can continue to do what they do best.
So now with your CMBS platform, what asset classes, are most favored? I know, most CMBS lenders are going to say that, well, we do everything, but we know, being on the inside, that there are some asset classes that are more favored than others. From your perspective, how would you describe that on your platform? What are the asset classes that you might consider more favorable than others?
So I'd say, CMBS is really a core plus asset base. So, I mean, we've seen everything lately. Hotels have been picking up a ton. We've seen tons of hotels coming through. We've seen retail centers starting to pick up. We've seen everything from cold storage warehouses. It's really been picking up in pretty much everything. I think the one asset class that I would say, is a little bit harder right now is going to be the office. The office asset class across the country struggled through COVID, and it's still, people are still working from home. Companies are still trying to figure out what the new work from home, the work in the office balance is going to be. So we've seen a lot of companies go from 100,000 square feet down to 15,000 square feet, just because they don't need the space, because they're doing, come to work Monday, Tuesday, they'll have a different group Wednesday, Thursday, and a different group on Friday. So they're really utilizing space together, which makes the office asset class a little bit more volatile right now, that we're still trying to figure out who's going where, who's gonna occupy what space. There's still vacant office buildings across the U.S., but really every other asset class has been picking up a ton. I mean, hotels.
Well, it's surprising that they hear you say hotels. I remember when hotels was that asset class nobody wanted to touch, and now the CMBS market is starting to find favor with hotel assets.
Yeah, hotels. I mean, hotels, like you said, it was nobody wanted to touch, and it's really been a quick shift in the last 30, 60 days that finally it's back into, the forefront of people's minds, and it's back into lenders wanting to play in that game again. Again, I hate to bring up COVID again, but it scared people.
Right.
The hotels, people weren't traveling, people weren't going. There were certain hotels that did great, and there were certain hotels that, really struggled. And so I think now coming back to reality, coming back to a normal, hotels are back in the game, and people are out exploring, people are out enjoying life and having a great time. And so I think that's really why the CMBS platform is, accepting hotels again.
Right. Well, here recently we've seen a little bit of economic shifting with regards to interest rates. I don't know if you've noticed, but based on with what you've seen, based on your experience, your history in the business, what do you think the economic impact is in this environment to where interest rates are rising? Not only that, but they're rising so rapidly. What do you think the impact of that's going to be over the next 12 to 24 months?
So I think it's going to be huge. I mean, the interest rate environment, as we all know, a year ago, we are still in 3% interest rates. We are just starting to see increases a little bit. And I mean, it's really been a roller coaster to the top, and we hope we're at the top, but you know, tomorrow is a new day, and tomorrow is a new adventure to see what goes on with interest rates.
Yeah.
You know, if I knew what was going to happen a month from now, I could retire today and be good to go and, you know, be making millions if I knew, but nobody knows.
Right.
So I think the rising interest rate environment has, you know, caused some issues, but there's been a lot of people that have money that are looking for that perfect deal, and knowing that rates are rising doesn't mean that they're not buying. It means that they're really actually learning their deal. They're learning the property, which I think is something that over the last couple of years, it was, we got to buy it now, because if we wait 30 more seconds, somebody else is coming in.
Right.
I mean, properties were going up for sale with 15 offers on the first day, whether it was $1 million multifamily, whether it was a $50 million multifamily.
Right.
People were out buying because rates were so low. So I think that, you know, the other issue that created was bridge debt. People, you know, a year ago didn't think that rates were going to be, you know, 6%, 5.5%. They thought, hey, we're still going to be exiting, you know, 4%, 4.25%, and it's not like that anymore. So I think that creates a whole nother issue that we're going to see in the next 6, 12, 24 months of some of these bridge debt coming due, and people are going to have to bring cash to the table.
Right.
You know, you're not going to be able to exit that $7 million bridge loan and, you know, go into permanent debt financing at 10 million, 8 million, even 7 million right now.
Right.
It's very tough to get some of these bridge debt out of bridge debt without bringing capital to the table.
Yeah.
And I think that's a big issue that's on the forefront of most people's mind. But the positive part is there is still a lot of cash on the sidelines, and people are waiting, people are ready, people are still have gotten more comfortable with where rates are at. I mean, we've seen a huge uptick in the last month. Freddie SBL came out with a February special of 40 basis points off and an extra year of IO. I mean, that's
good.
That was a kickstart.
And that's for the SBL, that's for conventional.
That was for the SBL program. So the SBL program is a little bit different than conventional, where, you know, Freddie SBL, you can lock rate at application. So you're holding that rate, you know, for the application, which is very, very attractive in a rising rate environment and in, you know, volatile rate environment. But this 40 bips off and next year of IOs really kickstart the market to, all right, we're looking at deals again, we're getting active. And I think sellers are finally starting to come down that, you know, we're in a time where sellers were in, 2021, 2022, they could sell anything, where buyers were in 2008 saying, you know, no, you've got to drop the price $1 million for me to come in. And I think we're finally getting on the same page, which I really believe is going to kickstart this market. People are going to start being active again. The people that are playing, that know exactly what deal they're looking for, they're going to start finding those deals.
Right.
You know, I believe sellers are going to start coming off their prices, and we're going to see, you know, we're not going to see negative, you know, cap rates down at 3.5%.
Yeah, I think those days
debt.
are gone for sure.
And that's the biggest thing. You were seeing cap rates compress so fast that nobody knew what to do. You know, interest rates were dropping, cap rates were dropping, and then out of nowhere, interest rates doubled, and cap rates coming to lag. You're 6 months behind, you know, at the end of the day. And so people didn't want to be negative leverage on day one. And so I think we're finally starting to see kind of that equilibrium happen, where buyers are being okay with where sellers are at, because sellers have kind of come back down. And it's really, you know, it's exciting to see. I mean, we're getting calls daily. We're getting people looking at deals again. People that we haven't heard from in a year are finally coming back, and they're like, all right, I'm ready to play. So even though it's been a rising interest rate environment, I think, you know, we're really starting to get a little bit more stable. And I think people are wanting to learn their deals, wanting to find the good deals, and are starting to find some. You've got to look hard. I mean, it's not, I don't think anyone will tell you that it's the easy, oh, I just stumbled upon this deal randomly. I mean, it takes 100 deals to find that one great one that you're like, this is it.
Yeah, but I think you're going to find more of them. I think that there are some groups, maybe some syndicators, maybe some groups that were experienced, a lot of groups that were very inexperienced, hadn't been through any market cycles, so they don't understand, you know, how to adjust for these market cycles. We're over leveraged going into deals, you know, betting on, you know, this, your TOEFIC environment that's existed for a while for these syndicators, and now they've got the music has stopped and they're still on the the little merry-go-round, and with no place to go, and so it's going to be interesting to see. You talked about that cash on the sidelines. There are going to be a lot of discounted deals that are going to be available. That's just my 20 years of experience, talking. So I don't know, but what do you think about that? You think there are going to be some opportunities coming up?
Oh, there's still there's opportunities today, and I think there's going to be discounted deals. There's going to be people that came in, bought it a year ago, started flipping, renovating units, and like you said, maybe weren't experienced enough to really know how to run and operate a property,
right?
Because it's not as easy as people like to make it seem. I mean,
I can't just go into some type of little thing and pay them $5,000 and they tell me how to become a real estate expert?
For some people it works, but I mean, to learn the grit, the nitty gritty, it takes experience. It takes bringing someone in that's, whether it's a mentor, but somebody that's on the deal with you, that's got it, that knows what they're doing. And I think that's really where a lot of people had the cash, but may not have had the experience. But as we all know, cash talks.
Yeah.
Sellers didn't care who you were.
Right.
Sellers were, you want to give me an extra 100,000? Oh, you'll give me 200,000. It became this bidding war of, who can raise enough equity or who can bring in enough. And, you were seeing deals at 50% loan to value because, your DSCR wasn't there.
Right.
When you're a DSCR based loans, you could be at a 120 debt cover and a 50% loan to value.
Yep.
And that's where people were, they're used to, Freddie SBL was 80% loan to value. That's one of their most attractive things.
But it doesn't work.
We haven't seen 80% loan to value in a long time. And, I hope we start to get there again, but, until it's kind of the same thing. These deals are going to start to make sense. Opportunities are going to be there. I hear about them all the time. And I hear the nice thing that I'm hearing is the people that are looking at these opportunities are truly underwriting these deals. They're looking at the financials before they send it to a broker, before they send it to a lender. They want to make sure it makes sense, and they're being conservative about it because, they're not willing to overpay.
Right.
They're not willing to be negatively leveraged. They don't want to go into bridge debt and be, stuck 12, 24 months from now because rates have raised. They're really learning their deal, and that's the biggest thing that I tell everyone. Make sure you know your deal before you bring it to me because, if you don't know what you're trying to sell me, how am I going to know what to sell Freddie Mac? And, you've got to tell me the story so I can then work with you to tell Freddie the story. This is, Freddie and Fannie both. But if you don't know where your deal's at, if you don't know, the story of what happened before you bought the property or what, why did they buy it a year ago and why are they exiting now? There's something happened. Did, the property where, what happened that made people leave? What happened that made people, was it rent growth? Was it, if you want to talk about rent growth, we can go all day that, people are shocked that they're not able to raise rents 20% every year still. We lived in this environment the last few years that, everyone was winning. It was,
it was hard to lose.
Yeah, you're at a broken casino and you pull the slot machine and ding, 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 another jackpot. Right. And so I think that's really what, like you were saying, distressed assets are going to come because, that casino is shut down for everybody. Yeah. You've got to really work and you've got to really make sure that this deal makes sense that you're going into.
Yeah. Now, you mentioned one thing that's important, and I think some underestimate. When you're applying for an SBA loan through the agencies, Fannie or Freddie, how do they view that borrower's experience, and what role does that play in perhaps having that loan approved or not approved?
Yeah, so experience is the biggest thing. Agencies really aren't there to be your first multifamily lender. They don't want to have somebody that doesn't know. They want the more experienced people, and I think that's where the story comes in. So the real experience requirement is pretty much 2 years across the board. Varies, there's nuances with it. Freddie, you want 3 properties for the last 2 years, or 3 properties with the first being acquired 2 years ago. Okay. So that's the experience they want. They look at how you're scaling. If you went from a duplex to 250 units through 30 different properties in the course of 2 years, they're going to say, hey, let's take a look and make sure that all these properties are operating. So the experience is really key, you know, but that's also what sells the loan. If you're coming in and maybe it's, you know, a very small market in the middle of Indiana with 10,000 people, but you want to buy the property there, your experience on what you've done in the past is really what's going to sell the loan to them to say, hey, we're comfortable with, you know, this loan. Maybe it doesn't have a stable T12, a stabilized T12. They're going to be more accepting of it if you've got experience that you've bought assets that didn't have a stable T12, that didn't have, you know, maybe you bought an asset with 70% occupied. You went in, renovated, got those units occupied, and now it's a stable property. That's where the story helps. The story helps, and, you know, the biggest part of the story is the experience, the operator. You know, even though we're looking at the property, we want to make sure that you know exactly what you're doing too. Because at the end of the day, you know, we're not here just making loans to everyone and saying, you know, you get a loan, you get a loan. It's not the agency's business. They want to make sure that, you know, what they're doing is successful and what, you know, the property owner is doing is successful. I want to say they've taken back 2 or 3 loans in the course of all of SBL.
Really?
So since 2015.
So whatever they're doing is working.
Exactly.
Right.
And that's the key, you know. I know they have guides and requirements and people get frustrated. They say, hey, you know, I've got the experience, I promise. Like I've done a bunch of single family, I've done things like that. But really, you know, they want to see the same like and size. You know, if you've owned 5-10 unit properties and are now buying a 150 unit, they're going to be a little bit skeptical saying, hey, are you sure you're ready for this big jump? You know, do you have the management company? Are you self-managing it? Do you have your own management company? Are you using third party? And that's where the experience and the story, and again, knowing your deal really helps. If you know what you're going to do, what your plan of action is, it's so easy to tell the agencies, hey, look, this guy, this girl's got everything. Here's their plan. Here's step 1, step 2, step 3. We're coming in, we're doing this. You know, we're getting the property up to what it should be. So the experience is huge.
Wow, that's interesting. So with regards to Regions Bank entering into this space, and their whole strategy is to acquire Sabal, but, you know, governance, you know, it really controls. And I was telling you the story about my experience with Regions Bank 20 years ago. One of the first deals I did as a broker was with Regions Bank, and there was an issue with me collecting my brokerage fee. They just didn't like me getting paid for doing work. You know, didn't understand it. But as far as but that's so brokers who bring deals to you now, you know, that's something that Regions has overcome, that bias of not paying people for doing work or not paying brokers.
Yeah,
you know?
No, absolutely. I mean, I love brokers. You know, some of my best friends are brokers in the industry, and, you know, we're doing deals every day. We're talking every day. You know, my biggest thing is if you're bringing me a deal, if you're a broker coming in, you're doing just as much work, if not more than I am. And I'm going to make sure at the end of the day that you're getting paid, that everything is going smooth. You know, it's your client. If you're bringing me a deal, that's your client. I'm not going around to, you know, call on your client and say, hey, you know, let's bypass him. That's not the way, you know, the world should work.
Yeah.
You should never bite the hand that feeds you. And, you know, I'm grateful for the relationship that I have with the broker. And so my biggest goal, you know, is to make sure that not only does a borrower have the best experience, but the broker has to have just as good of experience. Yeah. You need to have the communication.
So, I mean, we're doing the marketing, we're acquiring the client, we're qualifying the client, we're making sure the deal is packaged right, we're advising the client. You know, for someone to make an arbitrary decision, say, well, you don't deserve to be paid for that work.
Yeah.
That just, you know, but I'm glad to see Regions making that shift. I've always have thought highly of Sabal Capital. As I mentioned to you prior to our show, I think you guys have a phenomenal platform, and the growth of that business, it speaks for itself. And so Regions is smart in acquiring Sabal, but I think it's a great move now that Regions has opened itself up to participate on the CMBS side and also the agency side of the business. So congratulations with that.
No, we're excited. We're excited to be a part of Regions. You know, we're going from a small company under 100 people to their Birmingham office alone having more than 100 people. I mean, it's definitely a giant shift in, you know, what we were used to, but they bought us for a reason.
Yeah.
You know, they loved that we serviced our own loans, and they love our servicing platform that, you know, this tiny company with 100 employees who service their own loans, Regions is now servicing all their own loans using our platform. So it's, you know, it's a win-win for everyone. And, you know, at the end of the day, it's the same thing like brokers. You know, we're all a team. You know, joining this merger, you know, or this acquisition, it's really all of us have to work together to be successful. And that's the Regions team, that's the Sabal team. And that's really what we've seen so far is everyone has been so helpful. You know, we call and ask, hey, how do we, you know, what do we do for anything in the Regions system? Somebody's there with an answer right away, giving all the information. And it's really been, you know, I think a big step up for us to continue to be successful in what we do. And now our footprint has grown. And, you know, Regions Bank is well known throughout the country. And so now we're trying to, you know, make sure that not only are they going to be East Coast, but know that Regions Bank is now owner of Sabal Capital, and that we are going to continue to do the same things that we did at Sabal Capital and bring that into Regions Bank.
Oh, fantastic. Well, thank you so much, Mr. Austin Barrett, Regions Bank, formerly Sabal Capital, I guess merged with Sabal Capital. Keep a lookout for them. We'll make sure that Austin's information is on our screen. If you want to reach out to him, if you brokers out there want to reach out to him and bring him some deals, I'm sure he'd be interested in talking with you. And then if you hotel owners out there, you're looking to finance your properties with CMBS lending, you know, please give him a call. Or of course you could call us and we'll represent you if you want, right? But Austin, thank you so much for being with us. Love to have you back on the show. It's always interesting to come back and to see the economic environment, how it changes, and then how you guys adjust to that. So maybe next year at our show here at the MBA CREF conference in San Diego 2023, maybe again we'll see you in 2024. But until then, if you're a member of our audience, there are a couple things I ask for you to do. One, like this episode. That allows us to bring in quality folks that we can talk to about what's happening in commercial real estate. And then you want to subscribe to our channel so that when we produce a new episode, we will be sure and alert you. But until then, thank you for being a part of the Capital Playbook. And thank you so much, Austin. And we look forward to seeing you again in the future.